Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sphere Entertainment Co. annual report. Sphere Entertainment Co. offers a diverse range of businesses and services through its two segments, Sphere and MSG Networks. The company's entertainment medium, powered by cutting-edge technologies, creates multi-sensory experiences for audiences. This includes various forms of live entertainment. The MSG Networks segment provides regional sports and entertainment networks, offering direct-to-consumer and authenticated streaming products. These services include a wide range of sports content, such as live local games and other programming. Unfortunately, I do not have access to the text that was supposed to be provided. However, I can still provide a general overview essay on what could cause a stock price to skyrocket. The sudden surge in a company's stock price is often a result of a combination of factors. One major reason is the release of positive financial results or earnings reports, which indicate a significant increase in revenue and profits. This news can attract investors who are eager to capitalize on the company's growth potential. Another factor that could contribute to a stock price surge is the announcement of new business partnerships or collaborations with other prominent companies. This can create a buzz around the company as investors become excited about the potential for increased market share and revenue growth. Additionally, a company's stock price may skyrocket if it has developed innovative products or services that are in high demand. If a company is able to corner the market on a particular product or service, its stock price can rise significantly due to investor enthusiasm. Finally, external factors such as changes in government policies or regulations can also impact a company's stock price. For example, if a new policy favors a particular industry, it can create a surge in demand for companies operating within that sector. In summary, the sudden surge in Sphere Entertainment Co.'s stock price is likely due to a combination of positive financial results, innovative products or services, and external factors such as government policies or regulations. Sphere Entertainment Co. market capitalization of $4 billion is materially smaller than most of its industry peers of roughly $17 billion. Sphere Entertainment Co. trades at a higher price-to-earnings ratio of 156 times and a higher price-to-book ratio of 1.84 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an examination of Sphere Entertainment Co.'s financial data. A notable increase in revenue by 15% from $10,739 million in 2022 to $12,163 million in 2023 indicates a positive trend. This growth is also reflected in the company's net income, which increased by 58% from $1,248 million in 2022 to $1,975 million in 2023. The improvement in cash flow from operating activities is another significant factor contributing to revenue growth. The increase of $201.6 million from -$57.6 million in 2022 to $144 million in 2023 suggests that the company's operations are becoming more efficient and generating more cash. Additionally, a decrease in cash used in investing activities by $15 million from -$60.2 million in 2022 to -$45.2 million in 2023 indicates that the company is managing its investments effectively. The adoption of new accounting standards, such as ASU number 2023-7 and ASU 2023-9 may also have contributed to the revenue growth by improving financial reporting and transparency. However, it's essential to consider these changes in conjunction with other factors to understand their impact on the company's overall performance. In conclusion, the primary drivers of revenue growth for Sphere Entertainment Co. appear to be a combination of increased revenue, improved cash flow from operating activities, and effective management of investments. The net income of the company underwent significant fluctuations between 2022 and 2025. In 2022, it decreased due to reduced affiliation revenue from non-renewal with Comcast and the impact of the COVID-19 pandemic on affiliate rebates. The trend continued in 2023 as increased debt service obligations caused by rising interest rates further decreased net income. However, in 2024, net income plummeted due to substantial operating losses and negative cash flow. The situation improved dramatically in 2025 when net income increased due to revenue growth, reduced expenses, and improved operating efficiency. This turnaround was a result of the company's efforts to streamline operations and capitalize on growing demand for its services. Profit margins also experienced changes during this period. Initially, they were impacted by fluctuations in distributor affiliation rates and subscriber counts. The loss of carriage or subscribers, including Altus's non-carriage period in 2025, further decreased profit margins. However, the company was able to improve its profit margins in 2025 due to revenue growth, reduced expenses, and improved operating efficiency. The key drivers behind these changes were revenue growth in 2023 and 2025, reduced expenses and improved operating efficiency in 2025, the impact of the COVID-19 pandemic on affiliate rebates in 2022, and increased debt service obligations caused by rising interest rates in 2023. The company's financial performance suggests a significant improvement in its ability to generate cash from its core operations. In 2025, the net cash provided by operating activities reached $243,346, indicating a substantial increase from the previous year. This positive trend is a welcome sign for investors and stakeholders, as it demonstrates the company's capacity to manage its resources efficiently and generate sufficient cash to fund its growth initiatives. The contrast with 2024 is striking, where the net cash provided by operating activities was negative at -$112,194. However, this setback appears to be an anomaly rather than a trend, given the substantial improvement in 2025. The company's ability to turn around its operating cash flow and achieve positive results in 2025 suggests that it has successfully addressed any underlying issues and is now on a stable footing. The company's debt level has undergone significant fluctuations over the years. Initially, there was a high leverage as mentioned on page 14. However, after a mandatory cash sweep payment, the debt reduced to $153.5 million from $158.9 million, page 18. The balance of consolidated debt outstanding increased to approximately $830.4 million by December 31, 2025, page 23. A significant change occurred in January 2026 when existing debt was refinanced with a new credit agreement, page 24. Furthermore, the acquisition of remaining equity interest in Holoplot led to an increase in debt level, page 25. Additionally, there were significant changes due to the refinancing of the 2022 LV Sphere Term Loan Facility and introduction of new credit facilities, page 79. In terms of interest expenses, there have been notable changes. Initially, there was a decrease of 37% from $111,428 in 2024 to $70,546 in 2025, page 55. However, this trend reversed with an increase of 122% or $31,560 in interest expenses, page 63. A hypothetical 200 basis point interest rate increase led to a further increase in interest expense on credit facilities by $11,574, page 85. The company's performance varied across different segments and regions. On the positive side, Abu Dhabi showed a strong performance, while the Sphere segment also saw an increase in adjusted operating income of $164,225. However, some areas struggled to meet expectations. The Las Vegas region faced issues with construction costs exceeding initial estimates, resulting in poor performance. Additionally, the MSG Networks segment experienced a decline in adjusted operating income of $12,241. These discrepancies highlight the need for closer monitoring and improvement strategies in underperforming regions. The company has made several strategic acquisitions and divestitures over the years to shape its business portfolio. In terms of acquisitions, MSG Networks Inc. merged with a subsidiary of Sphere Entertainment Co. on July 9, 2021, marking a significant expansion of the company's operations. Additionally, the company acquired the remaining equity interest in Holoplot on April 25, 2024, building on its previous investment and financing extension to the firm. Furthermore, MSG Networks Inc. holds a 30% interest in Sako Technologies Inc., which was acquired in fiscal year 2019. On the other hand, the company has also made several divestitures to streamline its operations and focus on core business areas. Notably, MSG Sports was spun off from MSG Networks in September 2015, allowing both entities to operate independently. The company also divested MSGE Distribution, which may result in a significant tax liability. Furthermore, the sale of land in Stratford, London took place on June 30, 2025, marking another notable divestiture. The company's financial activities for the year ending December 31, 2025, reveal a notable trend. One significant action taken by the company was the repurchase of shares. Specifically, they bought back approximately 1.1 million Class A common stock shares for around $50 million during this period. In contrast to share buybacks, there is no record of dividend payments made by the company during the same year. This indicates that the company chose not to distribute any profits to its shareholders through dividends, instead opting to retain earnings or use them for other purposes such as investments or debt repayment. Supply chain disruptions pose a significant threat to business operations. The extracted summaries reveal several concerns regarding supply chain disruptions that could have a material negative effect on business operations. Interruptions or unavailability of third-party facilities, systems, and software, pages 15 and 37, may hinder business continuity. Additionally, disputes with distributors over affiliation agreements, page 19, could lead to administrative complaints, litigation, and termination of agreements. Furthermore, potential losses of media rights due to default under existing agreements or inability to renew on acceptable terms, page 21, pose a significant risk. The COVID-19 pandemic has already caused supply chain issues, as seen in the construction of Sphere in Las Vegas, page 30. Moreover, construction delays at DCT Abu Dhabi's Sphere Abu Dhabi project, page 47, highlight the potential for ongoing disruptions. These concerns underscore the importance of mitigating risks associated with supply chain disruptions to ensure business continuity and minimize losses. That concludes the financial summary for Sphere Entertainment Co. Feel free to comment below, and I will be happy to answer them when possible.